All right. Well, good afternoon, everyone. My name is Josh Strittmatter. Welcome to Social Security, 7 Keys to Enhancing Your Benefits. A little bit about myself before we get going here. My name again is Josh Strittmatter. I have been a continuing education instructor at UTA since 2010. I'm also a certified financial planner. I own my own financial planning practice for the last 19 years. But teach various classes, both webinars and in person at UTA. And we've got a lot of classes coming up, so check out our lineup on their website to learn more about our classes. Some key disclosures before we get going. Everything today is purely educational, so it's not meant to be specific advice nor tax or legal advice. Please talk to your licensed professionals before taking any action. This presentation was actually created by Allianz. Allianz has their own disclosure page that I'll show you there, and we're just borrowing it. Also, as we go along today, if any of you have any questions, feel free to just type in your question in the chat feature. I'll be monitoring that as we go along. Social Security often has lots of questions, so be sure and ask your questions, and then I'll take some questions after the class is over as well. So let's make sure that you get all your answers today. So let's get going. Let's talk about Social Security, folks. So Social Security provides options to you, and that's one of the key takeaways today, is that it is not just a cut and dry, start that benefit and you're done. There are ways to take out Social Security that you can optimize the benefits that you're going to receive. So today we're going to talk about several of the key things that you need to know about Social Security, including benefit basics. So I'm going to educate you on how Social Security works. We'll talk about income benefits and what you can expect to receive, when you should start your benefits. If you're working in retirement, what you need to know in terms of how that will affect your Social Security, and then tax implications, how Social Security is taxed, and then we'll talk about spousal and survivor benefits, and then finally we'll end with Medicare basics. Now, at the end of this, I've got some great handouts, not handouts because this is digital, but these are PDFs that, if you're interested, has a lot more information that I'll be providing to you via email. And so I'll tell you how to get those PDF and at the end of this presentation. I already have a question. So it says, will I discuss public pensions and windfall and how it will affect the benefits? This presentation doesn't have that, but I can touch on that a little bit. And then I do have a great handout for you, Craig, that has some great information as well. So I'll try to mix that in a little bit as we go along today. Okay, starting off with Social Security benefit basics. So as of June of 2021, there are 65 million Americans who are taking Social Security benefits and it's about $1 trillion that's being paid out. Now, a lot of people think that Social Security is just simply Social Security benefits for retirees, but it actually pays out to 3 different groups of people. And so you have the retired workers, which is the major chunk of it. 76% of the benefits that are paid out to retirees. Then you have disabled workers and their dependents, which receive the next big chunk, which is 15%. And then survivors of deceased workers, 9%. You can see the average monthly payout is not that high. So $1,555 is the average monthly payout for a retired worker. Aged widow and widowers and parents, $1,462, and then disabled workers, $1,280. So you're not going to get rich off of Social Security. All of you probably know that, but indeed, it does help in retirement. In fact, it's the #1 source of retirement income for retirees in America is Social Security. A lot of people are concerned as to whether or not Social Security will be there. And a lot of people say that to me all the time. They say, Josh, will Social Security be around when I need it? And the answer is yes, folks. And here's the reason why, is that what's happened over the years, Social Security used to be a social insurance program meant to be a backdrop to people who lived too long. Well, what happened is life expectancy went up. And so because life expectancy has gone up, it has now become a retirement program for all of America. And so many people have become dependent upon it to be able to live. And so if Social Security ran out of money, you'd have a much bigger problem with poverty in America. And so I just don't ever see that happening. But The Social Security system is based on two trust funds. You have the OASI and the DI trust fund. OASI is the retirement trust fund, and then the DI trust fund is for the disabled. So the OSI trust fund is expected to be depleted by 2034. And when I say depleted, that doesn't mean that doesn't mean that you're not going to get your benefits. So what that simply means is that the assets within it would be depleted. However, we would still have tax revenue, and tax revenue would continue to pay you in your benefits through your retirement, but they would pay out at a smaller percentage because the trust makes up a portion of the amount that's paid out to you. So you'd receive 78% of your benefits, assuming the trust fund runs out. Now, here's what I would tell you over the years, and I've seen this happen several times, is that the trust fund, they let it go all the way down to the finish line, and then they fund it for the next 20 years. And so I think that the reason why they do that is for politics, is that it's a great platform to run on if you're a politician, to say, hey, I'm going to correct Social Security. And then that way they can keep doing it over and over, and the politicians can keep getting reelected. So that's just my theory. But I don't think you have anything to worry about. Again, if we didn't have it, there'd be a bigger problem. Next, a lot of people are curious as to what their benefits are. And many of you may know that they stopped mailing Social Security benefits out a few years ago, but they started to back up, but they do it in 5-year increments. Every 5 years is when you can receive your statement. You can also just go online anytime you want to and get your benefit statement. So if you go to ssa.gov, that website right there, you can log in, and it's going to ask you a series of personal questions. So what car did you drive when you were 16? Things like that. But you need to answer those correctly. So because if you don't, it'll lock you out, and then you have to call in, which is kind of a pain. So you can have instant access. As soon as you get through their system and you create your account, you'll have that PDF that's directly available to you right away. And then further, you would log in anytime you want to get your statement. Once you do log in and you do set it up that way, you no longer get mailed the statement. So just as a heads up, once you do that, you want to make sure you keep the username and password so that you can log in and look at it each year. Let's talk about some income benefit basics here and how Social Security works. So for Social Security, you have to be fully insured to be eligible to receive benefits. What fully insured means is that you have earned your 40 credits. And so the way that it works is you can earn 4 credits per year. And so therefore it takes 10 years of work to receive your 40 credits. And so 1 credit is worth $1,510 earned in a year. And so therefore 4 credits is $6,040. That's how much you have to earn in a year. The 1510 to earn 1 credit, again, $6,040 to receive the 4 credits. Wages, the credit system changed a little bit, but if you, since 1978, you would earn credits on the basis of your annual earnings up to the 4 credits in any year. Before that, it was a little bit different. So just depends on when you start working. Let's talk about how your benefits are calculated. So the PIA is the primary insurance amount. This is your full retirement benefit age amount. So your full retirement age is based on when you were born. I'm going to show you a chart on that in just a second. But when you are fully eligible for your full benefits, that's called your primary insurance amount. And the primary insurance amount is calculated based off of your average indexed monthly earnings. Average indexed monthly earnings going back for the last 35 years, using your highest 35 years to calculate the index benefits. So it doesn't have to be consecutive years. So if you work 40, it goes back further than 35 years. It goes back your entire working history. But it's not consecutive. So it's your highest 35 years, non-consecutive. And what happens is those monthly figures are indexed up, and that's how they come up with this calculation. Now, what you need to know is that if you take benefits early, they reduce your primary insurance amount. And then if you delay taking your benefits, they increase your primary insurance amount. So in other words, all calculations are based off of your primary insurance amount. And then again, your benefits will start based on when you were born. And so for anybody born from 1943 to 1954, age 66 is their full retirement age. So again, that's when they're eligible for their full retirement benefit, not reduced. And they can start benefits as early as age 62, but there would be a 25% reduction if they did that. What happens is every year after that, the full retirement age is delayed 2 months. So all the way through 1960, if you were born in 1960 or later, your full retirement age is age 67. And if you took your benefits early, again at the earliest age, 62, you would receive a reduction of 30% for taking those benefits early. Again, you can also delay taking your benefits to age 70. And in doing so, you get what are called delayed retirement credits. So delayed retirement credits, let me see, I'm going to go back a slide actually. Delayed retirement credits, the way that they work is it's based on when you were born as well. For most people, it's 8% per year. So by delaying it, let's assume your full retirement age is 66. If I delay it to 70, that's 8% per year growth in my income benefit, and it's off of my primary insurance benefit amount. So 8 times 4 years, so 66 to 70 is 4 years, is 32%. I'd receive a 32% increase by delaying my benefits to age 70. That's quite substantial, folks, and quite beneficial for those of you that can take advantage of it, because that benefit allows you to provide a benefit to a spouse that can be a higher amount, and even a survivor that's even a higher amount. And I'll talk more about that here shortly. But also remember that Social Security indexes. What that means is that it goes up from year to year with inflation. And so when you delay it to that higher amount, it's indexing off of that higher amount. So you'll receive more in retirement by delaying it. So a lot of people will ask me, Josh, when is the best time to start my benefits? And again, you can start at anywhere from age 62 to age 70. And this chart shows you a hypothetical example of the full retirement age of 67, full retirement benefits of $2,000 a month. So that's the primary insurance amount, their age 67 benefit amount. It's going to assume no cost of living adjustments and no discounting, and that their benefits are first received the month following the month that they are due. And it reflects 12 monthly payments. Let's see if there's anything else on that. What this chart is going to show you, folks, is the break-even point. So you'll notice here, if you start your benefits at age 62, by the age of 70, you would have received $134,400. By the age of 80, you would have received $302,000. By the age of 90, you would have received $470,000. If you delayed till 66, you would have received $89,000 by the age of 70. By the age of 80, you would have received $313,000, and by the age of 90, $537,000. So we're going to skip this one. We're going to go all the way down to 70. So by age 70, you would have received nothing, right? Because you just started at age 70. But what's interesting is how much more you receive by the age of 90. So 595 versus 470. So $125,000 difference by delaying it to age 90. Now here's the key, folks. This is what you need to know. Look at this. Look at age 80 here. Look at this column. Notice how all of these amounts are very similar. And this is what you need to know, is that it doesn't matter what age you start Social Security benefits. You're going to receive the same amount of benefits by your life expectancy. Social Security life expectancy is right around age 80. It's actually closer to age 81. But what that means is, again, is if you live to your life expectancy, you will have received the same amount, no matter if you started at age 62 or if you started at age 70. Where it begins to get larger is when you have delayed it. And so when you go beyond life expectancy, that's where you start to see these numbers get much larger. And so the question is, well, do I think that I'm going to live to 80 or age 81? And, the average age to live to is age 82. Actually, if you're a male, it's a little bit longer for a female. Depending on when you were born, you can look at life expectancy tables. If you don't think that you're going to live that long, you should really start your benefits as early as possible. Again, there may be some reasons why you don't want to do that. You may be working, which would affect that benefit. Or if you had a health condition, that's another reason why we tell people to start benefits early, because they have a health condition that would cut short their life. But if you think you're going to go beyond that age, it really makes a lot of sense to delay taking your benefits. And the one thing that I would tell you folks is that medicine keeps getting better and better and better. And so the likelihood that you're going to live into your 90s is pretty good these days, unless you just, again, have some sort of health condition. So that's why we recommend clients think about delaying it to 70, because it's a substantial difference in the amount that you're going to receive over the course of your life. So again, main takeaway from this slide is you receive the same amount no matter what age you start by the age of 80, approximately the same amount. The real benefit of delaying it comes after that age. Let's move on to talking about working in retirement. And I mentioned earlier that if you start your benefits early, they may reduce your benefits if you continue to work. So here's the chart that tells you the answer here. Let's see if there's one more. Nope. So looking at 2022, these are the new numbers published for 2022. And these numbers index every year, by the way, so they go up every year. If you start benefits at the earliest age that you can, which is age 62, and you continue to work, so you're working and you're making earned income from a job. That's often the confusion. This is not a pension that's affecting your benefits. It's not, income from your investments. It's only earned income from a job that we're talking about here. So if you have earned income from a job, if you make above $19,560, they reduce your benefits by $1 for every $2 above that amount, until you reach your full retirement age. And then, and this is actually the year of your full retirement age, all the way up to your full retirement age birthday month. So January 1st, my birthday is March 17th. So March 17th, it's a very short window of time, in other words. That's where it switches from $3 for every $3 that I make over $51,960, it's $2 reduction in my Social Security benefits. So again, a very short window, but at full retirement age and after, there's no more reduction in my benefits. And in fact, what Social Security will do is they will modify your formula to pay back what you didn't make during those early years of taking Social Security benefits. So they'll modify the formula to pay that back. But it's something to consider, folks, is that if you're thinking about working, it may not be to your benefit to take Social Security benefits early, just because they're going to reduce it. Here's an example of this. Let's see if I can. Susan was born in 1960, and so she retires in 2022 on her 62nd birthday, but she returned to work less than 1 year later. And the benefit's 1514. Actually, that's just the average. So her benefit is 18,660. And again, because she started it early, there's a 30% reduction in her benefits. So don't be confused by this. There's two reductions that you're going to see here. The first is because she started her benefits early, and that's a 30% permanent reduction. So that does not change. The other reduction is from working. And so $13,000 is the 70% of her primary insurance amount. She's going to earn $40,000 from her job. The limit, again, is $19,560 for Social Security. So therefore, every $2 off of that is $1 reduction, or excuse me, every $2 over that amount is $1 reduction in her benefits. So $20,440 is the overage. divide that by 2. That's how much they're going to subtract from Social Security. And then she nets $2,842. So that's simply 13,000 minus 10,000 is that 2,842. So the question is that worth it? And I would tell you, I wouldn't do that just simply because I could get so much more by waiting. And then I have more options. I can retire 1 year later fully and not have a reduction. Keep in mind that if Susan changes her mind, so if she wasn't planning on going back to work, but then she changed her mind and went back to work, she has 1 year to turn off her benefits and reverse what she was paid out. She has to pay back what she was paid, but it starts it over as if she never received her benefits if she just takes that 1 year window of time to reverse it. So that gives you that one option if again, you find yourself in that situation where you weren't planning on working, but maybe you got a good job offer and you said, hey, I'm going to take that job. You could stop your benefits and just pay back what you took. Okay, let's talk about some tax implications. So a lot of people don't know this, but Social Security is actually taxed twice, folks. And all of you should get out your sheet of paper today and make a note to write your congressperson and to say that is absolutely something that should be changed. But when you get paid, they actually withhold income tax from your Social Security amount that's withheld. Then when they pay you the Social Security, when you start your benefits, they take income, or you pay income tax again on that amount. So you're actually taxed twice on your money. Again, not a great thing. So that's within our control. Write your congressperson. So here's how the taxation works. It looks at what's called your combined income formula. So it's your adjusted gross income. That's basically looking at all of your income and taking out your above the line deductions. Then you add your non-taxable interest. Non-taxable interest is from municipal bonds. Then you add back half of your Social Security benefits. That creates your combined income benefit amount. So then that combined income is applied to thresholds. So it's based on which type of filer you are. If you're a single or head of household, that threshold, that range works this way. So for combined income of 25,000 or less, you pay 0 tax on your Social Security. For 25,000 to 34,000, you pay up to 50% tax, not tax, up to 50% of it is taxed. And that's often confused as well. And the tax that you pay, by the way, is your ordinary income tax rates, whatever bracket that you're in. And then 34,000 and above, 85% of your Social Security benefits are taxable, which means that 15% are never taxable to you. And that's something to remember, is that 15% of your Social Security benefits are not taxable when you start your benefits. If you're married, 32,000 or less is 0. Between 32 and 44,000 is up to 50% of your benefits are taxed. And then above 44, 85% are taxed. So that's how taxation works with your Social Security. Let's talk about spousal and survivor benefits. So the great thing about Social Security is that if you're married, it can provide a benefit to a spouse that's based off of your record. If they've never worked, they can actually receive an income based off of your earning record. Let's go through the ins and outs. So a non-qualified spouse can collect on the record of the spouse who is qualified to receive benefits, but they must have been married at least 1 year to the spouse or be the parent of their child. If at FRA, that's the full retirement age, so we'll just assume that's 67 or later, received an amount equal to 50% of the PIA, the primary insurance amount of the qualifying spouse. And then if at age 62, they may receive permanently reduced benefits. So they can actually receive benefits as early as 62, but the benefits would be reduced. So we're talking about spousal benefits and what you're eligible to receive. If you've never worked and you never therefore paid into Social Security and you're married, you can receive up to 50% of their primary insurance amount, of your spouse's primary insurance amount at your full retirement age. Again, if you started early, it's permanently reduced. So the other thing that you need to know is that to receive spousal benefits, your spouse will have to have started their benefits. So you can't take spousal benefits unless your spouse has started their Social Security benefits. And that's if you are a non-qualified spouse. Now, if you're a qualified spouse, meaning you have actually paid into Social Security and you qualify for benefits, you can receive the higher of your own benefit based off of your own earnings history, or half of your spouse's benefit, and that's their primary insurance amount, their age 67 benefit amount. You're eligible to receive the higher of those two. And it's actually a two-part calculation, just so you know, but that's kind of getting to the weeds of things. But just what you need to know is that if you did work and you're eligible for Social Security, you could actually get a higher amount if your spouse's benefit is a lot higher than yours, and half of it, and so half of their benefit is higher than your own benefit. And then here's an advanced option. And so the rules changed back in 2015. This really doesn't play much into the numbers anymore, but I'll share this with you because a lot of people have questions about this. When they changed the rules, they grandfathered in some of the people. Most of that has been phased out, though. So the way that it worked is that people who turned age 62 or older in 2015, they could still take a spouse's benefit before their benefit. Well, so what would happen is their spouse would start their benefits and then suspend their benefits, which would make the let's do spouse A and spouse B so as to not get confused. Spouse A is the main income earner. Spouse B is the one that is going to take the spousal benefit. So spouse A would have to start and suspend their benefits, which would make spouse B eligible for a spousal benefit. And they could take that benefit and delay taking their benefit until they turn full retirement age. And in doing so, they get delayed credits. Now, again, to be able to take advantage of that, you had to do this back in 2016. So this is really phased out, but it's still talked about. So we talk to people about it. So the other great thing about Social Security is that it provides a benefit for a widow or widower. And so the way that these rules work, they're a little bit different in that you can start a benefit as early as age 60 if you are a survivor. And if you do start them at age 60, they are permanently reduced, though. That's something that you need to know. However, there's a kind of a cool trick that if you start your survivor benefits, I should say, at age 60, you can actually delay your own benefits until your full retirement age or later. And if you do that, if your benefit is higher, you'd receive that higher amount. So that is something to consider if you have had a spouse that has passed away. Be sure and understand this idea that you may be able to take advantage of a strategy to get a higher benefit while starting a spousal, or I should say survivor benefit at age 60. So be conscious of that. And if you know, by the way, if you know people who their spouses has passed away, I always tell people, this is not common knowledge. You don't get a lot of information that's told to you around Social Security unless you go do your own research. So tell your friends that if they've just lost a spouse, be sure and let them know that they can start benefits as early as age 60 and that they can just start the survivor benefit and delay taking their own benefit. And if it's higher, it would benefit them. So that is survivor benefits. And then looking at divorced spouse benefits. A lot of people don't know this. If you were married and now divorced, you can actually draw benefits off of your ex-spouse's record. But there are some requirements. You have to have been married for at least 10 years. Your ex-spouse receiving benefits must be age 62 or older and unmarried. Their own work record is less than benefit. And it's based on the divorce, and less than the benefit based on the divorce. Amount of benefits has no effect on the other ex-spouses or their current spouses. So just so you know, if you draw off of your ex-spouses and they remarried, by the way, this was read wrong. So you must be unmarried. Your ex-spouse can be married, just to clarify. So, and that's what this other rule is about, is that you can actually draw off of their benefit even if they're married. And what that implies is that your ex-spouse is actually, two people would be drawing, actually three people, if you include the ex-spouse, would be drawing off of that one work record, work history, which is one of the problems with Social Security, just so you know, but it can be done. The divorce had, you have been divorced at least 2 years, and if both spouses are at least age 62, the divorced spouse can get benefits even if the other spouse is not retired. So even if they're not retired, you can still get the benefits. So again, takeaways on this slide is that if you're divorced, there's the potential for you to draw spousal benefits off of your ex-spouse. You do have to meet the rules. And again, the rules are really centered around you. So keep that in mind. Before I move on to Medicare, let me briefly touch on the windfall elimination provision and the pension offset. Now, this applies to people who are, so what I'm about to talk about, folks, is not on your screen. This is just as a side note. When you work for a government entity and they pay, and they're going to pay you a pension, so that's part one. Part two is, and they're not also paying into Social Security on your behalf, because there are pensions that they actually pay into both. UTA is an example of that. UTA pays into both the pension and Social Security. So in that case, they're going to get their full benefits from both. But if you work for a government entity that doesn't pay into Social Security, what's going to happen is you're going to have reduced benefits. And it's reduced because your Social Security is based on you working the full 30 to 35 years. It gets a little bit complicated to receive the full benefit. So when you look at your statement, it's assuming you work the full number of years to receive your benefits. So if you don't do that, in other words, you don't pay into Social Security that entire time frame, naturally it's going to be a reduced amount. And that's what a lot of people get confused about, is that they think that they're owed the entire benefit, but they don't realize that the benefit amount that's being showed on their statement is actually assuming that they worked the full number of years to receive that benefit. So when they cut that short, they're going to get something less. And you can go on to the Social Security website, and there's a calculator for both the pension offset and the windfall elimination provision that will show you exactly what your benefit is. You just type in the dollar amounts taken directly from your statement, and it will show you what that reduction will be. So let's see. Here's a question. Next spouse has been married. They couldn't draw off your. So if an ex-spouse gets remarried, I think is the question. So again, you can draw off of an ex-spouse if you're not married. So again, that's not related to what I was just talking about. That's the ex-spouse benefits. But again, is if you're not married, you can draw off of the ex-spouse benefits. It doesn't matter whether or not your ex-spouse is married or not. Hopefully that answers your question, Catherine. Okay, so those are some things that you need to know about Social Security. You know, here's the thing, folks. There's lots of information on SSA.gov. I've got some great resources that we can send to you as well. But it really is important for you to understand Social Security and to make sure you pick a good strategy for how to pay yourself, because again, that's going to be the guaranteed lifetime income that you're going to receive. And it's the one pension in most cases that inflates. So it's going to help you keep up with inflation over the course of your life. Follow-up question from Catherine. What about if he remarried and divorced? Can he still draw off mine? So it gets a little bit complicated there, Catherine, where you can actually draw off of, you can actually choose from different ex-spouses if you get married multiple times. But again, is if he has to be divorced to draw off of yours. But if he gets remarried again, that's where it gets complicated, as the answer to your question. And I'm happy to walk you through that, but it's beyond the scope of this presentation today. So just reach out to me and I'll kind of give you all the answers. Another question, how do teachers fit into this when their district does not pull Social Security? Yes, so if you did not pay into Social Security and you receive TRS, you're going to receive a reduced Social Security benefits, even if you have your 40 quarters. So again, your 40 quarters is just eligibility. It's not, it does not determine the amount that you're going to receive. So if you're not eligible, you won't receive benefits. If you're eligible, you receive benefits, but that benefit may be reduced if you did not pay the full amount of time into Social Security. And again, you can go online to check out the calculators to see what that reduction will be. Let's move on to Medicare. And it's important, we talk about Medicare with a Social Security presentation because they are very much related, and they can start around the same age depending on when you start Social Security benefits, but we often get lots of questions around Medicare. So this is a good precursor to those of you that have not started Medicare. It's also good information if you have. So for Medicare, benefits start at age 65. There's no range, it's just at age 65. You're eligible the first day of the month you turn age 65. If you're already receiving Social Security benefits, when you start your benefits, they will automatically enroll you in Medicare, so you don't have to enroll. And then if you're not currently receiving Social Security benefits, you must enroll to receive your benefits. It's important to do so, and they open that window when it's 3 months prior to you reaching age 65. It's actually a 7-month window, so it's 3 months prior to your birthday month, and 3 months after. If you don't do it within that window, you will pay a penalty for delaying starting your Medicare benefits. So, and it's a pretty hefty penalty, folks. So be sure and start your benefits if that's what your plan is. And there are 4 parts to Medicare. So you have Medicare Part A, which is the hospital insurance, Medicare Part B, excuse me, which is the medical insurance, Medicare Part C which is the Medicare Advantage plans, and then Medicare Part D are the prescription drug plans. So the way that it works is you have 2 paths that you can go down when you're taking Medicare. The first is the traditional path, as it's called. That's where you take Part A and Part B. The second path is where you do the Medicare Advantage plans. You still sign up for both parts, but you're adding a Part C, and this is managed care. So this is much like if you have health insurance now, this is much like your health insurance now. It includes things like vision, dental, or it can include these things, health and wellness programs. So for people who want more of that HMO or PPO type program, that's what the Part C provides to them. The majority of people take Part A and Part B, just so you know, and they don't take the Medicare Advantage plans. So my advice to you when you're trying to determine which path to go down is to get good advice. And we've got some people that we refer to that are great at this if you need help, but definitely get some good advice before you take that, because there are implications of starting one over the other that they can penalize you for switching, just so you know. And then again, Part A and Part B, if you have prescription drugs that you take, you typically would add Part D to that plan. So original Medicare, that's what I just talked about. And then Medicare Advantage plans, Part A, B, C, and usually D. And then Part D, so basically 3 decisions that you have to make. How do you want to get coverage, the traditional path or the Advantage plan? Do you need to add prescription drug coverage? And then do you need to add supplemental coverage? And that's the Medigap plans. So Medigap plans are A through J, and they provide additional benefits beyond your traditional benefits. You don't take those with the Medicare Advantage plans because that's the purpose of doing the Medicare Advantage plan, because they provide those benefits already to you within those plans. And so that's where people have a kind of a tough time trying to figure out which Medigap plan to take. And that's where a professional can help you, walk you through those different decisions, different plans to help you make a decision. So this is a good kind of top level way of thinking about Medicare. Gave you the deadlines, Now, if it's getting close for you, I encourage you to start digging in and becoming knowledgeable about it. Okay, folks, so today we talked about your benefit basics for Social Security, the income benefits, when to start working in retirement, tax implications, spousal and survivor benefits, and Medicare basics. What are your next steps? Well, understand all your filing options available to you to enhance your benefits. So again, lots of different ways to pull Social Security out. It's important to evaluate those, make an educated decision. Determine what your needs will be in retirement, and if the Social Security is going to cover those expenses or if you'll need additional income sources. So annuities are another way to create income sources. Again, that's this only us as the provider of this presentation, and they offer annuities. And if you'd like specific advice, you're welcome to talk to me as well. I mentioned earlier that we have several free reports that I can send to you. And these will actually be on a website that you can just go download them. So it's Social Security Filing Strategy, Social Security Retirement Brochure, Understanding WEP and PO, that's what I mentioned earlier for those of you with government pensions, and then Social Security Retirement Brochure as well. Actually, that's on there twice. So those 3 documents will be on that page. If you have questions, you are welcome to schedule a complimentary consultation. Our phone number is there listed there, 817-210-3444. You can also email us at clientservice@strittmatterwealth.com. We also have some great newsletters that I always like to plug. If you go to my website, it'll pop up right for you. We have a weekly market update, which is fantastic. We also have a retirement newsletter that comes out monthly. And then we have in events, we host lots of classes, teach lots of classes. And so we send a newsletter that sends out the dates for those classes. Also, I have a radio show every Saturday at 10 a.m. on 1190 a.m. where I answer financial questions that people submit, a show called Ask the Experts. So if you'd like to listen to that, we would love to have you. 1190 a.m. at 10 a.m. on Saturdays. So folks, thank you so much. I hope you've enjoyed today's presentation. I hope you've learned a lot. And I'm going to stick around for just a minute to answer any other questions that you have.